Good evening, ladies and gentlemen. My name is Darren Ong, and I'm Head of Platform Growth in iSTOX. Thank you once again for logging into today's webinar titled New Opportunities in Private Capital Markets. It brings me great pleasure to welcome you because I'm passionate about opportunities the proprietary iSTOX platform brings to underserved segments of the investing community and the platform's mission of providing more choices and better opportunities to all. Our first speaker tonight is iSTOX Chief Commercial Officer, Ms. Choo. Oyi has 20 years of capital raising and merger and acquisition advisory experience. Prior to joining iSTOX, Oyi was UBS Singapore Head of Investment Banking. She is currently an authority member of the Civil Aviation Authority of Singapore. Tonight, Oyi will be reviewing the financial market performances under the current COVID-19 situation as compared to the SARS and global financial crisis. She will also share developments and trends in the private capital markets and assets that global family offices are increasing allocation to. If you would like to ask any question, you may do so at any point during this webinar. Simply click on the Q&A button, which is represented by two speech bubbles at the bottom of your Zoom screen. If you do not see this Q&A button, please move your cursor to the bottom of the screen and the Q&A button should display. And I will pose your questions to the presenters during the Q&A session. All right, Oyi, please take it away.
Thank you, Darren. Well, welcome everybody to our first webinar. Good evening or good morning to all of you. I hope you're all keeping well during your respective lockdowns. We're certainly in one. But the good thing about having a lockdown is it gives me more time to look at what's happening in the public markets. And so I'm nervously following what's happening today. The Asia exchanges have not done or have been quite stable, but not very well. And every day we're watching news around what's happening on COVID-19, whether there are new government stimulus packages. And so every day, sort of every jump up or down provides some excitement for us. I took some reference to historical data, and maybe might be an interesting time to think about what happened in two series of crises. First was the SARS crisis between 2002 and 2004, and the GFC between 2008 and 2010. And we take a look on the 2002 when SARS first happened. I take us back to November 2002 when the outbreak similarly began in China. It then spread to the rest of Asia in 2003. But in reality, the SARS virus, as we now know, is not as easily transmittable as COVID-19, and therefore it was relatively contained in Asia. I believe also as we were coming off the back of the dot-com bubble bursting, the markets were already sort of in a transition period. And in reality, the markets did not, it slid maybe about 10% or so, the STI as well as the Dow, but it recovered relatively quickly. So by mid-2003, I think markets were back up and, off we went. During the global financial crisis, this was obviously catalyzed by the bankruptcy of Lehman Brothers and the nationalization of Fannie Mae and Freddie Mac in September 2008. Now, this was a much more drastic decline in the financial markets. I think it was over 50, close to 60% drop over 6 months. The government announced a massive stimulus package in 2009, and that's really when the market started to turn back up. Now, while SCI recovered to pre-GFC crisis by the end of 2009, the US took slightly longer to recover with obviously such a large structural and systemic shock to its financial system. Now, how do we think the COVID-19 situation will evolve? Since the first case reported in December 2019, the virus is obviously spread globally, so far wider than SARS, and has a much deeper impact on lives and the global economy than SARS. In anticipation of a potential financial crisis, governments have rapidly put together large economic stimulus packages, buoying somewhat and stabilizing the markets for now. Now, We are not clear how long this will play out, but suffice to say, the stimulus package that the US Senate announced for $2 trillion compared to the $787 billion during the financial crisis. And every other large economic centers have announced their own stimulus packages. And therefore, you will see even though it's a short 3 to 4 months, the market has actually stabilized somewhat. It dropped about 30% in February, March, but has bounced back about 10%. Now, in such volatile times, some investors will be feeling the pain of margin calls and seeing their portfolio value diminish. Some other investors who have cash on the sidelines in the meantime are actively looking for value opportunities. We hear a lot of families who are now waiting on cash just to pick up stocks that they historically have waited or thought was too expensive, and now was a very good time. And this market dislocation has opened up a window of underpriced securities. But we talk about the public markets, and every day we watch it with trepidation, and we wonder what is going to happen, whether leverage or margin calls are going to happen in the market. So we all should stop and think, what other asset classes or opportunities might there be that an investor like yourself should consider and allocate capital that would enhance your own personal portfolio risk-reward profile? Now, we're going to talk a bit about alternative investments and how we think that adds to everybody's portfolio. The alternative space, outside the listed stocks and listed bond space, they actually include quite a wide range of sub-asset classes. And these include hedge funds, private equity, real estate, infrastructure, venture capital, commodities, and even art and antiquities. Institutional investors have traditionally used alternative investments to diversify their portfolio. As you can see on the left-hand side, they have low correlation to stock markets, mitigate volatility of the stock markets, and potentially higher returns. Of course, the trade-offs include illiquidity, a potentially higher risk, and sometimes higher fees, as there is a higher intensity of management required for some of these assets. If we look down at the charts, PGIM Institutional Advisory and Solutions study of risk return of asset subcategories from January 2000 to March 2015, you can see, if you can see the small font, the S&P 500 had a return of just slightly above 4%, but its risk was actually in double digits, so around 15%. Whilst a global macro hedge fund, one would think would be higher risk, actually returned close to 6% with a risk of less than 6%. So if you look at the risk spectrum, the macro hedge funds were on the far left. For a similar risk profile to the S&P 500, one could invest in opportunistic real estate, but the return profile was actually much higher at 8%. Now, the same study also showed that during the same period, most of the alternatives, except for venture capital, had a smaller maximum drawdown than the S&P 500, which is quite an interesting statistic. And we'll dig into a few of the sub-asset classes a little bit more. One specific illustration is the historical performance of buyout funds. The returns of private equity buyout funds across the US, Europe, and Asia Pacific outperformed the respective regional stock indices over a 1-year, 5-year, 10-year, and 20-year horizon. So across the financial crisis, across SARS, across a very long horizon. This outperformance is the #1 reason cited as to why private markets continue to attract significant amounts of institutional capital. On the next page, just quickly, hedge funds. I know hedge funds have a bad name, but if you track through the performance of hedge funds between the periods of 2002 and 2004, as well as 2008 to 2010, you will see that hedge fund generally performed quite well. And I would pull out, for example, global macro funds, who have outperformed the S&P and the MSCI World Index. As such, what we've seen is private capital fundraising have grown significantly in the last decade. Sovereign wealth funds are allocating more than 20% of their portfolio into alternatives. Pension funds are increasing. They used to be about 10 to 12%. It's now increased to 15 to 20%. And because they see the benefit of the diversification of alternatives to their broader portfolio. Now, this has also resulted in an expansion of the investor base to the ultra-high net worth investors. In a recent global family office study conducted by UBS, over 40% of the portfolio of global family offices surveyed were invested in alternatives, and these were in private equity funds, hedge funds, real estate, REITs, private equity. And this trend is going to continue. Of course, this survey was done just before the virus, but I believe that this trend will continue to stay. There's a significant increase in allocation to direct private equity, significantly increased allocation to private equity funds, and an increase in real estate REITs as well as hedge funds. Just to quote a recent article from Straits Times, with fixed income investments yielding little, zero, or negative returns, and equity investments too risky, investors are being driven into alternative investments, such as private equity and real estate. I wanted to spend a few minutes on specific high-profile private market investments, just to give a flavor of what are the good big names that are out there raising capital. Late in November 2019, Global Logistics Properties, as you remember, was a large listed logistics platform that was listed in Singapore. It was had a large shareholder with GIC, and they privatized some years back. They set up GLP China Income Partners. It was a 2.1 billion fund focused on investing in stabilized, income-generating modern logistics in China. These were very well subscribed by very large institutional LPs, limited partners. In May 2019, KKR closed this European buyout fund. It was considered its flagship European buyout fund. It was a 5.8 billion euro fund focused on private equity related transactions in the core markets of Western Europe. In July 2019, BlackRock closed its Global Credit Opportunities Fund. This was a 2 billion fund to invest in corporate credit assets across geographies and industries, seeking value throughout the credit cycle. Now, more recently, you would have imagined that nobody would have the gumption to raise money in this market, but we did actually have two very interesting fundraisers. The first was March 2020, DE Shaw, which is an extremely well-known hedge fund, closed its composite fund. It was a 13 billion hedge fund that traded across asset classes, including fixed income, stocks, and asset-backed securities. Again, it was an opportunity to take a position in the dislocated markets for a hedge fund like DE Shaw. And they certainly found investors that were willing to put money in to back them. The last one I wanted to cover was a slightly different, not a fund, but a unicorn in Southeast Asia. Gojek is a ride-hailing company based in Indonesia, but they are across Southeast Asia. They managed to raise 1.2 billion in March in this last month, increasing its Series F round to just under 3 billion. So private markets have been resilient through the COVID-19 crisis. They've been able to attract and raise very large amounts of capital. And we believe these opportunities actually are presenting itself to high net worth investors, not just the global family office. What do we see in the trends in this private market? Well, the total AUM in Asia itself is already 1.1 trillion in 2018. This was growing 40% from 2017. So there's a massive scalability and growth of the private market just in Asia alone. The continuous rise of income level in Asia will create demands from investors to look for different asset investment opportunities across different asset classes. the rise of Asia tech startups and emerging unicorns in Asia has generated a lot of public interest and investment requirements. And of course, the increased technological savvy of Asian investors, as well as the use of mobile devices to access investment platforms. All these factors are coming together to shift the behavior and the mindset of investors. And therefore, we see a new or evolving breed of high net worth investors that are more demanding and will require different, different sort of aspects of investments.